Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. Thank you for all the subscribers on the comments. I greatly appreciate it. This week's episode is going to be Lockheed Martin. Behind me is the most recent earnings report from Lockheed Martin. We're going to go through Lockheed Martin like we do every stock here at this channel, where we look for 5 key attributes for all of the investments that we cover. We look for top-line revenue growth. We look for earnings growth. We look for strong free cash flow, low debt, and a well-priced stock. Those are the 5 key attributes that we look for every investment. We measure all of our stocks this way. We come up with what we believe the stock is worth to us. Then we look out in the market to see what we can buy it at. And if we can buy it at a substantial discount to what we believe it is worth, that is our intrinsic value. That is what we inherently will earn over the life by holding that stock. We are not stock flippers. We're not here to be in and out 1 minute, one second later. We're looking to buy a business that's going to generate cash flow for a decade, 2 decades, 30 years, maybe even give the security to our children. That's how long we want to buy a stock for. And we want to make sure it's fundamentally sound, and we do that by looking over a long period of time. In this case, we use 9 years. So behind me is the most recent 10Q, which is their annual filing done on a quarterly basis. They haven't fully come out with the 10K yet, but this is their earnings release with the unaudited year-end numbers for 2020. But we can go through it. It's going to be close enough for us. We'll get a gauge of what 2020 looked like for Lockheed Martin. We'll look back in time. We'll see what did they do over historically, and what do we realistically think conservatively? What are we willing to bet our money on that they will do in the future? And if with a conservative forecast, the future holds a strong return, fantastic. If they beat it, all the better. But we know we're not paying too much for the forecast, and that's the main point that we look for when we're trying to buy a stock. Let's go dive into the numbers, which is where everyone wants to talk about. So I have pulled numbers from Lockheed Martin for the last 9 years, and let's walk through the revenue to get a feel for what they have been doing. And it's actually very, very strong. I have liked this stock for quite some time. I'm happy to review it at the channel, and I'm certainly happy. Recently, the price has come down, so it's going to be a little spoiler alert, pretty interesting review. So $47 billion has grown to $65 billion. That's an annual growth rate of top-line revenue of 4%. So that definitely checks a box. It's no double-digit monster. I get that. But it's a steady movement up north. Well, I guess barring a little bit of loss, so not quite that steady. Fair enough. But it does churn out over time a good top-line revenue growth. What I particularly like is how they've been able to grow margin over that same period of time. You look at EBITDA growth, 9.5%. That is, I'll get double-digit, right? Let's round up a little bit. So that's a double-digit EBITDA growth over this period of time. Single-digit revenue, both checking the box and posting a pretty solid number over the 9-year period of time. So both those are both revenue and profitability for us. The way we look at it at the whole enterprise level does seem to match what we're looking for. If you come over here and you look at the debt, right? The debt is the very first piece that we use when we're building the enterprise value of a company. Enterprise value being the entire values, debt, equity, cash, the whole thing. It's basically doubled in 9 years. But given the growth rate of EBITDA, that's actually very conservative. So they've gone from $6 billion to $12 billion. I will note that in this entire time, I am not including about $12 billion of pension liability. So what you're seeing before you are the actual notes, bonds that they've issued out in the market. There's another $12 billion of pension liability that they keep on their balance sheet, which I have not included in here. So just footnote that there's an extra debt here. The reason it's important, if for some reason the financial market should change and the pension value that they have contributed is no longer as high as it once was, Lockheed would be on the hook to contribute extra money into that fund, the pension for the retirees. So it is an obligation, but I did include it here, just footnoting it. Cash, no excess cash, right? They have a good balance sheet. I thought it was roughly mid $3 billion cash on hand, but I left it all on the balance sheet because it's part of their working capital. I don't want to say it's excess. Market cap is fiscal year-end month, which is December, average December trading price times outstanding shares for the fiscal year gets me an average market cap that I use for the year. I add these two up, I get an enterprise value. Again, enterprise value being the entire market value, everything. So if you think of a house, if you were to buy a home on the open market, you pay the seller's asking price. How you finance that house by going and get a mortgage, that's entirely up to you. But the seller wants the market price. This enterprise value is the market price of Lockheed Martin. How management decides to finance Lockheed Martin, well, that's management's decision. So that's why we look at this value. It's everything. So now we've got an enterprise value, right? We know an EBITDA. Let's go look at our value metrics. What is it relative to earnings, and what is debt relative to earnings? So the first one I want to do is net debt to EBITDA. So that's taking this total debt that we have minus excess free cash flow, which is 0, dividing it by the debt figure to give me a turn, a years of payback is a good way to think about it. So they currently have 1.2 years of debt on the books, which is very low, right? We look for less than 3 times debt being a conservative metric of leverage. They have basically 1 year of earnings and they can pay off all of their debt. Essentially, EBITDA is not exactly earnings, but it's close enough for us. Also note that if I add the pension liability in here, 12 times 12 is 24, basically doubling this number, that puts you at 2.4 times, still below our 3 hurdle, even on adding the extra pension liability, which is fantastic to see. Our measure of value, at least when it comes to the P&L, is enterprise value to EBITDA. Again, payback period. If you buy the company today, you're buying it at this value, it's going to produce EBITDA or earnings here. How many years of earnings does the business have to generate to essentially buy itself? And that's what we want to know. And if you pay too much, if you're in this range, you're paying 15 years of future earnings for this company. That's high. But look at it. It's come down. It's come down a lot. It's now trading at 10 times earnings. That's actually that's past earnings, I believe. Yeah, that's this current last year's earnings, which is one of the lowest metrics we have seen in the last almost decade. So I think when we're looking in terms of relative value, there's a lot to like here, given it's been almost 50% more expensive in the past. And that could be good upside for us. If we get in here and it returns to this over time, fantastic. So I like this. I think it checks the box on value and it checks the box on debt. Let's go look at cash flow. My personal favorite statement. I think I've liked all the statements over the years of finance. I think I started with the P&L because it was basic and easy. Then I went to the balance sheet because I was super interested in the balance sheet. And then I finally got it and said, cash flow is where the cash is. You got to like that one. So here we go. Cash flow from operations. That is the first third of the cash flow statement. Cash flow from operation. This is the cash money, not profit. Remember, P&L, income statement. I say P&L, income statement. That's a profit. That's an accounting term. You can have things that are non-cash in there. Depreciation is an expense, a big expense for all these companies, but it's not a cash cost. This is actual hard greenback that they generated. So, to move forward, cash flow from operation from running their business, they generated $1.5 billion of cash. Last year, 8.2, let's round up, $8.2 billion of cash. When they were done with the year, it was sitting in a bank account. And they were like, okay, now what do we do with this cash? Well, I got to put some money back in the business, right? I got to make sure my building is painted, my ERP system is up to date. If I'm building a new building because I'm expanding, well, I gotta build the building. So here's some cash to do that. There's some basic stuff that they need to do to keep the gravy train rolling. That's this. CapEx, capital expense. You can find it on the cash flow statement in the middle third. It's called typically property, plant, and equipment, purchase of property, plant, and equipment. That's 1.7, call it $1.8 billion. What I like to look at is the spread here. They generated $8.1 billion in cash. Okay. But to keep this gravy train running, they got to put back 1.8 billion. So if that number is small enough here, that means this carries through to what we really want. If this is big, like some of the oil companies, Chevron, Exxon, whatnot, that's like 50% of this number. So that means they make all this cash, but they go and put half of it back in the business just to keep it going. Here, they're putting 1.8 billion when they made 8.7 billion. That is a lot less, and that's good for us. It's a high margin, high cash flow business, which you want. Debt payment, both the inflow and outflow. This is a negative number is an outflow, debt payments. A positive number is inflow, I borrowed. You can see they're buying down debt, relatively small. That means most of this $8 billion passes right through to free cash flow to equity holders, which is us. That's what we want. We are the equity holders, and this is what you're buying. You are buying this stream of future cash flow, if you want to get technical. If you want to do the present value, you can take this, stretch that out, discount that back to present value, you get your net present value. But we're doing it differently. It's a little easier to understand with the IRR calc, in my opinion. It's free cash flow. Shares. Shares is ownership. This is what you're buying when you buy, obviously, the share, but there's a fixed number that in an aggregate equals all of the equity holders of a company. And the more there are, the smaller the pieces. Think of a pie. You can cut the pie into different pieces, but you don't change the total mass of the pie, right? You're just slicing it more. Well, what they're doing here is they're actually canceling shares, which is fantastic to see. So they started with 322 million shares 9 years ago. And over this period of time, they have purchased in the free market with this cash. They've gone out in the free market, bought their shares, and torn them up. And when they tear them up, they can literally cancel them so that there are fewer left. And as they do that over time, that means that if you bought one share back in the day and there were 322 million other shares sprinkled out there, then you were 1/300 millionth of a shareholder out there. Well, over time, not only has your business grown, cash flow has grown, earnings have grown in the aggregate at the company level, but your percentage ownership of that bigger company has also grown because there are now fewer shareholders who lay claim to the same cash flow. So there was 322 million. There's now only 280 million, so fewer. That means your one share has a greater claim on this number, and this number is much bigger. Awesome. That is what we want to see. That's a 2% decline over years. Fantastic. Free cash flow per share, that's me just taking free cash flow divided by shares. Share price, I use the average price for the fiscal year end, this being December, average December price. I divide the two, I get a cash flow yield. Free cash flow yield. This is not the dividend yield. You'll notice I barely ever talk about a dividend yield. Why? Because it's not the full story. And the dividend yield is decided by management or the board will elect to pay out, it's called the payout ratio, a particular percentage of, typically it's net income, but we can use cash flow for right now, of this number. They will say, well, we generated 5.8 billion. We want to give 40% back as a dividend. So they kick out 40%. Your dividend would be 40% of this number divided by shares equal to, my point here is it's kind of arbitrary. Yes, they want to keep the dividend going, but the percentage that they give out, they can fluctuate, they can vary. So buying a company based on a dividend yield alone, in my opinion, is flawed because it misses the true value, which is all the cash flow. Whether they keep it to grow faster, make an acquisition, do what they want, or they kick it out as a dividend, you want to measure the company at the total level of cash it generated, which is this number or this yield. So right now, they're yielding 6%, which in a negative interest rate environment is a fantastic yield for a company that's growing earnings. We're calling it double digit, 9.5%, revenue, solid 4% growth, and a 6% yield is, in my opinion, a very, very strong number. ROIC is really strong, double digits. I don't know why it aired out here. Excuse me, my data source didn't have any data here, so I'll have to ignore that. But on the whole, it's actually a really strong double-digit number. Good for them. So this definitely checks the box on cash flow. Let's forecast and see what we get. Okay, the first thing I like to do is forecast EBITDA. So I'm taking EBITDA of 2020 and I'm bringing it forward 6% a year. If you recall, They actually were growing at 9.5%. And I'll go back to show you here. Actually, really strong double digits early on. And this is what I'm going to like about this stock right now. This is strong growth. I'm not giving it the strong growth, right? We can, but the industry as a whole, the aerospace defense industry is growing at a 4% annual CAGR. So I'm a little leery to just say, give it 9% in the future. I'm going to haircut a little bit and see if the investment can support this lower forecast and still have a solid return. If they beat this, which I think they could, all the better. I didn't pay too much for it. So anyways, 10 billion to 18.4 billion in a decade from now, which is a strong number, but I think very doable. The market multiple, 12.5 times. If you recall, this is that average, but you're buying it at 10. So we're going to see here, I think this is a trifecta case. I've referenced that before in prior videos where you've got earnings growth, EBITDA growing at 9.5% a year, fantastic. The next one is market multiple expansion. So we're buying it at 10 times EBITDA. I'm using a market multiple, which is the historical average, at 12.5. So I get that extra expansion of market multiple. And the last one is the share buyback, which you saw before. They're slowly reducing shares over time. Those three features in my mind are what I look for in a stock. It shows discipline in my mind and management's regard for the equity holders as a partner and not just a source of capital. So I'm using 12.5 times EBITDA to get enterprise value. That puts me at $228 billion of enterprise value, less a little bit of debt. This is just maintaining the same debt ratio, 1.2 times. Gets me that number, no excess cash. Gets me about a $200 billion market cap. I keep the same shares outstanding. I didn't shrink them even though I think they will, but because in this model we distribute all free cash flow, I have no cash left to buy back shares, so I'm leaving that alone. And when I divide my estimated future market cap divide by the outstanding shares on hand, I get a price target of $700 a share, which is a strong $708 a share, which is a strong a share price for Lockheed. Let's go look at free cash flow. So free cash flow, again, I'm keeping the 6% because really it looked like free cash flow from operations is in line with EBITDA, and the CapEx isn't dramatically swinging up and down. It stays relatively constant as a margin between free cash flow from operations and CapEx. So I'm keeping this the same. Last year they earned, I thought it was 21 something and change for the free cash flow to equity per share, growing at 6% to give me 37 and change forecasted free cash flow per share. I'm copying the yield. So you buy it at a 6% yield, it's still at 6%. You could argue that that thing should be lower, meaning a higher stock price. But again, to be conservative, 6%. And that gives me a $559 stock price out in the future. Let's go look at the returns. So now we've got two price estimates, 595 and 708 for two different methods. I'm just going to leave a 50-50 weighting. You can do it on your own if you want to split this some other way, but it gives me basically $650 future price target. Great. Now we have looked in the market. We've reviewed the company, and we think this is what I think it's worth. I'm willing to buy and put my money against the stock, and I'm only going to buy it for whatever because I think it's worth $650 in the future. All right, let's see what it's worth today. Oh, I can buy it for $325 today. Let me get this straight. I can buy it for $325 today. I've got low debt, growing top line, growing bottom line, strong free cash flow yield, and in the future, it's going to be worth $650, possibly future. Yeah, I like that. So let's take a look at the IRR. IRR calculation. You can do this in Excel on anything. I love the IRR calc. It's a great number. I get my free cash flow that the company generates. It is producing cash money every year. This is the cash flow. I'm in it 325. I'm out at 650, or just keep holding it forever if you wanted to. But for illustrative purposes, I got to exit some point to give you the IRR. This is the total stream of cash flow that this produces, and I get a 16% compounded annualized return on a very safe company with low debt that is growing at a conservative growth forecast, mind you. This is very strong. Considering the stock market right now is at all-time highs, and I'm struggling to find companies that I think are going to meet the double-digit return that we expect as equity holders, I think this is a great entry point for something like this. The next thing I want to do is I want to move the needle on the growth for you and show you if I move this up to 8%, what does that do both in free cash flow and the EBITDA? What does that do for the IRR? Well, it moves our target from, like, I think it's at 650 to 780, so adds another $120 a share, but it moves that growth rate to 19%, which anything near 20% on your money for a decade, that turns chump change into fortunes, ladies and gentlemen. That's a nice curly number if you're in the 20% for over a decade every single year. But we're going to go back to the 6% so you can see the 16% that I had. And now what I want to do is we're going to come over here and look at the distribution, that as the price moves up or down, you get a feel for what you can buy the stock at. Because the stock market's kind of like a random number generator, in my opinion. I think Buffett or Charlie Munger, even Benjamin Graham would always say it's Mr. Market, kind of walk in randomly, shout some random number that they're willing to either buy or sell a stock at, and you can just say, well, I like that number, or I don't like that number. That's essentially what, in my opinion, the stock market is. It'll throw out a random number at you, and you can say, I don't like that, I'll pass. Well, that random number can vary quite wildly, and you're seeing that in this market. There's some extremes going on. So if you sit back and say, well, it's 320 now. If it moves higher, almost to 400, what does that do to my IRR, assuming the rest of this model pans out? Well, you're still double digit. You're just not nearly as strong. You're still beating the long-term market average at a 13 or 11% return, but it's not robust like it is now. If it should come down even further for some reason, the market takes a bath or something like that into the 300 range, you're solidly the 20-digit IRR on the conservative 6% growth on EBITDA. So I think for me, for this channel, we're definitely a good on Lockheed Martin. I've liked the stock for a long time, like I have said. I've watched it rally and rally, but I think this recent pullback is a very interesting entry point if you're looking for a defense aerospace position. Boeing is still struggling a little bit. It's kind of had its run. We looked at Raytheon earlier, still like that company. I like that you're kind of buying you get another one for free. But this is an interesting play here. I like the company. So let me know what you think. Please hit the subscribe button, comment. If you're looking for stock ideas, definitely check out the comment section on this channel. There are some amazing stocks in there. I think someone just the other day mentioned Roadhouse that I liked a lot. I had no idea they were even public, but they're making money, they're growing, they're cash flow positive, low debt. I mean, it was a cool little company. But we'll continue to sift through companies. I hear you guys. I'm trying to work through them as best I can. Thank you very much for watching and supporting the channel. I greatly appreciate it. I have a lot of fun doing this. Let's do another one next week. Talk to you guys later. Bye-bye.